There are so many factors which affect the property market, so where are prices going to go over the next year or two? My name's Luke, I talk all things real estate, renovating and financial freedom. Drop a like on this video, subscribe to the channel down below, and let's dive straight into it. Now the talk over the last few months has been interest rate hikes. The RBA is going to continue to lift interest rates over the next few months, all the way out towards the end of 2022, and we could see a cash rate reaching 3% by the end of the year if they continue to be aggressive in their interest rate hikes. Interest rates are one factor in the property market, and Australia is markets within markets. In terms of property prices, we're hearing the news and major media talking about property price falls at this point in time, and should you wait or hold out a little bit longer to buy the dip? But it all depends on where your focus lies. The bulk of our media will focus on Sydney and Melbourne, as that's where the bulk of Australia's population is. But the truth is, the rest of Australia's market is either staying stagnant at this point in time, seeing a slight amount of growth, or continuing to grow like Adelaide is at this point in time. The facts are we don't really have a high level of unemployment, and so most people who want a job can get a job at this point in time. There's actually a labour shortage where businesses are struggling to find high quality staff. In areas like IT, in marketing, in accounting, those types of jobs are in such demand at the moment that we are seeing some wage inflation. Now, interest rate rises are going to hurt families' borrowing capacities. As you increase your interest rates in your serviceability calculators, the banks will continue to assess you at higher and higher interest rates. But they're going to cap your rental income, typically at 80% of the yield on the property, and they're also going to cap your personal income depending on your last 2 years of tax returns. What this essentially means is someone that was able to buy $1 million home 12 months ago might only be able to afford to buy a $900,000 home based on the bank's lending criteria. On screen, we can see the changes in dwelling values for the past month, the past 3 months, and the past 12 months based on CoreLogic's data from the 1st of July 2022. As you can see on screen, property prices are down by 0.6% in the past month, but they're up 11% over the past 12 months. So even though we're seeing a pullback across Australia's market as a whole, we've actually still had crazy run of growth in the last 12 months. Looking at our major capital cities and our regionals, South Australia is still going ahead in the last month with 1.8% growth. Most of our other markets have been stagnant in regional Australia. Looking at the capital cities, you can see that Melbourne and Sydney have had the biggest falls, with 1.1% drops in Melbourne and 1.6% falls in Sydney. The rest of our major capital cities have been either stagnant or seen some growth in the last month, with Adelaide being the best performer, followed closely behind by Darwin. Where I want to point you to is the increases that we've seen in the past 12 months in these capital cities. You can see that Brisbane has had 25% growth, Adelaide again 25% growth as well, followed by Hobart and Canberra with 16 and 13% respectively. And there's been a bit of growth in the Sydney and Melbourne markets with 3% and 6% growth in those major capital cities. What this means is the pullback over the next 6 to 12 months is likely to only be material in those major cities like Sydney and Melbourne, which are unaffordable at this point in time. My opinion is that markets like Perth, Adelaide and Brisbane still have potential opportunities to create value, to buy a cash flowing property and to put your money to work. Even with the interest rate rises that are forecast, these are priced in. Everyone's aware in the Australian market, the news and the media, and people like myself have been talking about interest rates and where they're heading. So it's not an unknown factor that people are going to be caught out of the blue with another 1% rise in interest rates over the next 12 months. Now, even though the Brisbanes and the Adelaides have had 25% growth over the last 12 months, we were playing catch up from that COVID period, and these markets were significantly more affordable than places like Sydney and Melbourne. Even looking at Brisbane today, you can buy a property from $700,000 to $1 million that's in a great location, that's within 10 to 15 kilometers of the city, that has local schools and shops and facilities and transport around it. And so when you compare that to the markets in Sydney and Melbourne, Brisbane has still great growth potential over the short to mid term. The way I see the market is I'm a long-term and fundamental investor. And what that simply means is I'm investing for the long term, but when I'm looking to make a property purchase, I'm looking to make big equity gains as quickly as possible by manufacturing value. I'm looking for something that's either blue chip and that can have that capital growth, or I'm more focused on something that's more of a cash flow play to bring more yield into my property portfolio, to boost my serviceability, and to boost my passive income. That all depends on where you are in your property cycle, in your investing journey. So earlier on, I typically suggest that you go for capital growth and then move towards cash flow properties over time as you look to buy less properties and potentially live off the rental income and the yields from your investing portfolio. Over this short-term period of time, I think property prices will continue to grow, but at a much slower pace over the next few years. We're moving back to where interest rates are at a normality, like in the periods of 2018, 2019, where we had a cash rate of 1.8 to 2%. The interest rates from the Reserve Bank of Australia might get a little bit higher than that to catch up with inflation and to balance Australia's market, but I still expect some of these major capital cities to have slow runs of growth and to still have great long-term growth potential as well. For example, in the Brisbane market, moving out towards the Olympic Games, a lot of people are expecting another bull run in between around 2027 to say 2030. And confirmation bias aside, because I am a Brisbane buyer's agent, I'm still very bullish on the Brisbane market over that next 10 to 15 year period. The most competitive markets will actually continue to be in that first home buyer space, where we've got first home buyers and first time or second time investors looking to buy into the market. In Brisbane, that price point is around that $600,000 to $700,000 mark, where investors and first home buyers are competing for properties. We're also going to see rental price increases creep up over time. As people come off their fixed leases, landlords are going to push up the prices to try and cover the interest rate rises that have happened in their property portfolio. Now, not all investors have debt in their portfolio. About a third of the market is actually debt-free. So those investors or owners won't be worried about the movements in interest rates. You can see on screen here the movements in annual changes in rents. So Brisbane has shot up 13% in rental price increases. Adelaide 10%, Canberra 10%, Sydney 9%, Hobart 9%, and the rest of the markets 7% or less. What this means is I can continue to see rental prices increasing over the next 12 to 18 months as those investors pass on interest rate hikes to renters. At the end of the day, I feel sorry for renters because they either have to pay up or move out and try and fight to find another property. Looking back, you can see there wasn't much movement in rental price increases between 2018 and 2020. But over the last year or two, we've seen massive spikes in rental prices and rental growth, and I continue to see that trend over the next 12 to 18 months. Then I think rental price increases will have moved through Australia's property market, and we're going to go back to that normality. So we have a two-speed market where rents are moving at a different pace to property prices. Property prices might be stagnating or slightly growing across Australia's major capital cities or falling in those Sydney and Melbourne markets, and rents I expect to continue to grow over the next 12 to 18 months, and then they might stagnate as well. So what does all of this mean, and where does this land in terms of long-term property price growth? I've said it before and I'll say it again, I would not be buying in the Sydney and Melbourne markets unless I was an owner-occupier or I could significantly add value to a property project in those locations. I think you'd be better off looking at major regional locations or heading over to the other major capital cities here in Australia. Of course, I run a Brisbane buyers agency, so if you want to have a chat, head over to purposeproperty.com.au and you can book in a free strategy session. But that's where I'd be spending my money, the major regional locations which have large population centres or the other major capital cities across Australia, which have relative affordability compared to our Sydney and Melbourne markets. No matter where the economics are and where the property market lies, there's always opportunities to invest. For Emily and I, we've always looked for value-add projects, for properties that people don't want to take on, for renovations that are too hard for other people and where we can add value. So there's always going to be opportunities depending on your skill set and your knowledge in the property market. If you're looking for something more buy and hold, maybe using a buyer's agent like myself or someone else out there to help you through that journey and secure the right property with the right cash flow, at the end of the day, the most important part is taking action No matter whether property prices go up, down, or in between, it's about putting your money to work over the long term. We are talking about fluctuations over the next 12 to 24 months, but really property investing is that long-term gain, looking to build wealth over a longer period of time. And I want to have my cake and eat it too, in that you can time the market and buy the right locations at the right period of time for that short to mid-term growth, and also spend time in the market by holding your investments for the long term. So if you're looking for ways to boost your serviceability and take control of your property portfolio, check this video out over here where I talk about boosting your borrowing capacity. Leave a comment down below as to where you think property prices will go across Sydney and Melbourne in the next 12 months. Drop a like on this video, subscribe to the channel down below, book in a free strategy session at purposeproperty.com.au. I'll see you in the next one. Peace.